Why does Bessent focus on the 10-year Treasury rate? That's because a low 10-year rate will not only help keep Treasury interest costs down, it's kind of a bellwether rate, but it'll also influence other key rates. The 10-year is a rate that reflects mortgage rates, corporate bond rates, and the overall cost of capital when calculating investment returns. So a lower rate is better for their program. Now, one significant task for Bessent is refinancing about $8 trillion in US Treasury debt this year, and he needs lower interest rates to keep down overall interest costs to do this. For the time being, he has to be selective about issuing treasuries across the entire yield curve. And like Janet Yellen did last year, he's right now issuing lots of T-bills at the short end of the curve. But to get rates down, there's at least one regulatory ace that Bessent, I think, is going to play pretty soon. He wants to modify the special liquidity ratio, the SLR, so that Treasury bonds would not count as risk-weighted assets on the balance sheets of commercial banks. Consequently, banks would not have to hold any capital, neither debt or equity, against their Treasury holdings. Now, this type of change would create a significant new demand for bonds, providing a substantial new source of funding for Treasury bonds. Now, we have historical precedent for this. After World War II, to help fund a very highly indebted government, U.S. commercial banks held treasuries worth about 40% of their total bank credit. Today, that number is about 6 or 7%. Therefore, there's a big potential for commercial banks to absorb a significant amount of treasury debt. And don't forget that when a bank buys bonds, it creates new money. So we could be getting a new kind of QE and potentially some significant inflation from the commercial banks based on a regulatory change rather than just by Fed action. So stay tuned for that.